We will now spend some time on the consolidated statement of changes in equity. When you present this statement, you need a proper heading again, P Limited Group, Consolidated Statement of Changes in Equity, and it's for the year ended 31 December 20x10. When you do a statement of changes in equity, you present that as a reconciliation of opening and closing balances of all your equity items. In the consolidated statement of changes in equity, you have two distinct sections. You have a column only for your non-controlling interests, being a specific, separate equity participant in this group. The other equity items all represent the equity attributable to the owners of the parent. So I want you to keep that in mind when you calculate these amounts. Everything that we have attributed to non-controlling interests move to their own column. What you left with the subsidiary together with that of the parent is what's left in the other columns representing equity attributable to the owners of the parent. Before we look at the calculations on this page, I would like to take you to the analysis of equity calculation, as that is a very helpful tool, especially when you have to present the consolidated statement of changes in equity or when you have to do the equity section in the consolidated statement of financial position. This analysis of equity is also a very helpful tool when you have to prepare your consolidation journal entries, and I will point out the reason for that. The first section of the analysis of equity looks at everything that happens at acquisition date, and the purpose behind this section of the calculation is to help you to write your at acquisition consolidation journal entry. So what are we working with here? We have the at acquisition equity of the subsidiary, and because equity equals net assets, that is my value of the business of the subsidiary, fairly valued. To that you compare what the parent was willing to pay for his portion, which is the cost of this investment made by the parent and the consideration paid. You can see the parent was willing to pay 118,600 Rand for his proportionate share of 105,000, and that led to a little bit of goodwill of 13,600. The parent also decided to measure NCI at their fair value, and their fair value compared to their proportionate share led to more goodwill of 5,000 Rand. But as I've mentioned before, we only present one amount for goodwill in the consolidated SFP, and you've already seen the effect of that when we looked at that SFP. So strictly speaking, at this point in time, you are not working with any of the amounts in these columns. You are only concerned about the value of the business, the equity of S. You need to know how much the parent was willing to pay and how much the parent measured NCI to be. Those compared with each other then either gives you goodwill or gain from bargain purchase. Just to make it even more clear, you are showing that 18,600 goodwill in the consolidated SFP. This 50,000 that you measure your NCI at already absorbs the 5,000 Rand goodwill that originated from their valuation. You are not adding that 5,000 again to NCI. It's already absorbed in the measurement of their amount at acquisition date. The analysis of equity then also has a section since to opening balance and a current year section. The reason why the analysis is set up like this is because it talks to the statement of changes in equity, where you have an opening balance and you show the detail of the current year movements in your equity items. In this analysis of equity, you are analyzing the total equity of the subsidiary, and you are calculating how much of that equity is allowed to be in the group first of all. That happens in your total column, and then second of all, how much of that is attributable to your equity participants of the subsidiary. In your since to opening balance section, you will then start with your equity trial balance opening amounts that you have available for the subsidiary, and the only equity item where we will see a movement is retained earnings in this example. You start with the TB amount of 127,500, and from that you deduct the at acquisition amount of 7,500 so that you are left with the movement since acquisition date. This discussion sounds familiar because I've already spoken about this when we did the journal entry where we attributed a part of the opening retained earnings of the subsidiary to the non-controlling interests. That was journal 8 where we wrote a consolidation journal entry for that 36,000 Rand. So immediately you can now gather from this that you can use your analysis of equity to write all your since acquisition date journal entries where we measure NCI. Important what I want you to remember here is that the reason why we deduct this 7,500 Rand at amount is because of the at acquisition consolidation journal entry. So you start with 100% of S, you apply the effect of the consolidation journal entry at acquisition date, and you are left with the movement. Then you write a consolidation journal entry for the portion attributable to NCI, and you are again left with the amount attributable to the owners of the parent. So everything that is attributable to the owners of the parent will be added to those columns in the consolidated statement of changes in equity, and everything that you've attributed to NCI will be added to their column in the consolidated statement of changes in equity. Please also refer back to the analysis of equity assignment where I have indicated this interaction between the analysis and the statement of changes in equity in a lot of detail. For the current year, your starting point is again the profit of the subsidiary, and we have discussed whether you adjust that for the effect of consolidation journal entries when we looked at consolidation journal entry number 9. That profit, when we have adjusted it where necessary, is then the profit of the subsidiary that's allowed to be in the group, and that gets attributed to the parent and NCI. For the NCI amount, we've already written that consolidation journal entry. Now, something you haven't seen in analysis before is the dividend. Remember, the dividend is part of the equity movement of the subsidiary, so it belongs in the analysis of equity. It's part of the movement. It's a negative movement. For the portion attributable to the parent, we have written that elimination journal entry for the dividend income, and then that journal 2 and 3 led to a debit to NCI. And here you can now see the effect of those two debits to the NCI balance. It would reduce their balance. After you've done that, this closing balance over here, let me just do that. The closing balance over there, that would be your NCI balance in the consolidated statement of financial position.